Hi, good day. Your finance doctor again, Dr. Meiya here at Explore Protech YouTube channel. We are excited that you joined us today again to explore matters finance and see how we can assist each other and assist you in better understanding your business and better managing its finances. If you are new to this channel, welcome, and we urge you to subscribe to the channel, comment on the video, and like this video, and invite other entrepreneurs to be on this channel, because this is where we speak about many things, but in particular today matters finance. So what are we talking about today? Today I want us to pay a special attention to the known cliche that says cash is key. While the statement by itself is not fundamentally wrong, I'd like us to take it further. That while cash is king, but free cash flow is the king. Why am I saying that? And maybe we need to look deeper into what are free cash flows and what make free cash flows better than cash itself. So really, a free cash flows looks into the cash that you as an entrepreneur at a company is able to generate after you have taken into account all the possible cash outflows. So you look at the cash inflow and the cash outflow, and the net of the two, that's what then will make the free cash flows. That's point number one. Point number two, it is really the cash that is left over after the company has paid all its operating expenses, including taxes, and has accounted for capital expenditure, both capex and working capital in particular. And thirdly, knowing how to calculate free cash flows and analyze it will also assist the company in better managing its cash. If you understand how the movement of cash is in your business, it puts the business in a better position to have a consistent and a focused cash management strategy. And finally, free cash flows is one of the ways that shows how efficient the company is in generating cash. Now, maybe we want to pause there, because this is one of the things that investors will have a special attention to, or financiers will have a special attention to, before they could invest and or they could fund the entity. They want to look at the ability of an entity to generate free cash flows. But what are the key takeaways about free cash flows that as an entrepreneur, as a business, you need to be aware of or take away? Firstly, the more cash flow a company has, the more it's able to allocate or declare dividends. Remember, dividends, even when you want to value a company based on the dividends approach, it's really a cash flow approach to managing the business. So the more free cash flows, the higher the likelihood that the company will declare dividends. And number two, as we've already said before, the more free cash flow a company has, the more it's able to speedily pay down its debt, or pay down the investors who had invested in the business. And thirdly, the more the cash it has, the more it's able to look at the growth opportunities, because if the opportunity presents itself and there's an available cash, then the company is able to capture those opportunities. Now, the way to calculate the free cash flow, there are many ways, but in the main, the three ways we can use is the operating cash flow approach, the sales revenue approach, and the net operating profit approach. Now, thirdly, while positive free cash flow is good, decreasing free cash flow it's not necessarily a bad thing, especially when the company is scaling or is investing in growth opportunities. So if you could show a relationship between the decreasing cash flow and a growth in the business, that also shows that the opportunities out there and the business is capturing those opportunities. Now, remember, free cash flow is just but one of the metrics you can use to gauge the financial health. You need to balance this approach with other metrics out there to look at the financial health of the business. Now, how do we calculate the free cash flow? Now, it's a very simple formula. Your free cash flows are really is the difference that comes from you look at your sales revenue, and from your sales revenue, you net off operating costs and taxes, and then you also net off required investment in operating capital. So that you understand each other, your operating costs will cover all your overheads, including the taxes, and if the company has it's leveraged, that will also include financing costs in that operating costs. And then when you look at the required investment in operating capital, there are two things that we're looking at there. We're looking at the capital expenditure, machinery, plant, and other related things depending on the nature of the business. But most importantly, the working capital. I hope you enjoyed the video. I hope it makes sense, and then you can go back and really look at it and look into your businesses, how you manage your free cash flow. Thanks for joining us. It's your finance doctor, Dr. Meiya, here at Explore ProTech. If you really like the video, please like this video, comment on this video. If you want to connect with me, please, in the links below, connect with me so we can have more conversations around matters finance. Till we meet next time, have a beautiful